Hey guys, Corey from Investor Life, and we help investors scale their portfolio without using any of their own money. Today's episode, we're going to be talking about how to analyze a property the right way. There's so many mistakes that can be done, and there's so many things that we can glaze over or forget to analyze. Even if we're a seasoned investor, we've bought multiple properties. So we're going to be going over this form. It's called our Property Analyzer. We go into the numbers in detail, but it also asks a whole bunch of interesting questions that we need to know the answers to, guys, if it's a property we're going to move forward with. As we go through this, we're going to share the screen. If you don't have a copy of this already, go to the description and download a copy. It's absolutely free. And it's a form we suggest you use every single property you purchase. So let's get started. I'm going to share my screen with you, and we are going to go through each of the sections of this Property Analyzer form in detail, just to make sure that you understand why it's important that we cover these bases. So here we go. We will share our screen, and we always start at the top of this of the form. So make sure you fill out the address. Why is it important we fill out the address and the date and the asking price? That's important because if we're comparing multiple properties, we want to make sure that we remember which one we're talking about. And sometimes we might be doing this 6 months later, 8 months later, a year or two later. And we might even be analyzing the same property at times, and we can look back at how we analyzed it a couple of years prior. So always good to put the date and the address. Once you have that, including the asking price, let's fill out the purchase details section. Now, I've taken the liberty of filling this out ahead of time, so you don't have to watch me typing this, and we can speed up this video. But you'll notice that we filled out every single section here. So our purchase price, the asking price was $500,000. In this case, we are projecting that that's what will be our purchase price. As investors, we put 20% down. That's standard in Canada as of 2023. That makes our mortgage $400,000. Our interest rate, we're going to pick a number of about 5%. Of course, this can fluctuate. I've seen as low as 1% in the last few years, and we're starting to see as high as 6, 7, or 8% on a mortgage. So we're going to analyze each property here based on a 5% interest rate. Amortization for investors is usually around that 30-year mark, 25 to 30. So if we put those numbers in a mortgage calculator, and you might be asking, well, where do I find out how much that mortgage payment is? Well, I'm going to show you exactly where you can go. And that's on our website, guys, at investorlife.com. If you go there to the toolkit, click on the mortgage calculator, you can enter these numbers, and it's going to tell you exactly what your monthly payment is going to be. So save investorlife.com on your bookmark so you can get to it quickly, and bang, you're there. You can figure out these numbers pretty quick. So that's how we figure out our mortgage payment. So that leaves us a down payment on this property of $100,000. A lot of times, and this is where one of the mistakes is made when it comes to analyzing a property, is people think, well, I'm going to buy a $500,000 property, and it's going to cost me roughly $100,000. But there are other costs involved that we may need to include, and we got to analyze these things as well. So in this scenario here, you notice that I put in legal costs of about $1,500. Other closing costs, who knows? We might have some surprises, some things we weren't expecting. So let's throw in an extra $1,000 just to be on the safe side. We're planning on doing slight repairs to this property. So maybe a room or two is going to be painted. We're changing a couple light fixtures. So we're counting on about $5,000 on this particular property. It happens to be in Alberta, so there's no land for transfer tax on it. But if you're in British Columbia, Ontario, or other provinces, this is a big number. This could be $4,000, $5,000, $6,000, $7,000 or $8,000 or more for your land transfer tax. So you want to definitely be including that in your purchase costs. Of course, you might have things like an appraisal, an inspection, and you'll notice the number we put in here for reserve fund. So we always suggest putting money aside, and you might say, well, I have a line of credit if I need anything, or I have this, or I have that. But if we put money aside for a particular investment, just in case something happens, in particular, the first year you own that property, you want to have money sitting in a bank account. So that's what that money is for. In case something goes wrong, where your reserve based on your cash flow is not built up enough yet. So you need some sitting there in case of an emergency. So you'll notice here in this case, the purchase costs end up being roughly about $16,000. So our total cash required to close is $116,000. That's 16% higher than if we were just counting on the down payment. So we want to be making sure that we include all of these costs in our calculation. Once we're done these sections, guys, the purchase details, the purchase costs, we want to go back up and figure out what our monthly cash flow is going to be, what our income might be for this particular property. You'll notice that the income here, the rents, our main suite, we're assuming that it's going to rent for $2,000 a month. Our basement suite in this particular property is going to rent for $1,200 a month, and we're going to rent out the garage for $300. So we have a total of about $3,500 a month in rent on this particular property that we're counting on. Now, you might be asking, where do I get those numbers from? How do I find out what a particular property might rent for? So there's a few different scenarios as to where you can go for that. And one of the suggestions, obviously, that we suggest you go to is definitely talking to your investment-focused realtor. The realtor that you're dealing with will likely have property management companies that they deal with, likely deal with many other investors that are buying investment properties, and will have a general idea what that property is going to rent for when they recommend it to you. If you're not working with a realtor, though, you may want to call up property management companies, do a little research, pretend you are a tenant looking for a property similar to that. Simply put it in Google. I'm looking for a 3-bedroom, whatever it might be, in this particular neighborhood. See what sites come up, look there. Start analyzing what properties are going for as far as rent's concerned. So do your research to make sure your numbers are good. For example, we go back to this analyzer here. If we then find out we can only rent this for $3,000 a month instead of $3,500, that is going to affect our cash flow dramatically. And it's going to affect the way we perceive this property. Our analysis of this property ends up turning out. So getting accurate rental income numbers is very important throughout this process. Okay, let's dial in a little closer to another important section here, and this is our expenses section. So we transferred our mortgage payment from down below here. We filled it out down here. We put it up here. We've also figured out what the taxes would be. We've either gone to the city website to find that, or we've got on our MLS sheet that our realtor provided us. We've done the research to find out. We've asked the homeowner, whatever the case is, we know what the taxes are going to be on a yearly basis. We divide that by 12. We figure out what our monthly taxes are going to be. Our insurance, if we don't know what the cost of insurance is, let's start calling some insurance companies. Let's call our insurance provider and say, I'm looking to buy a property like this. Can you give me a rough quote as to how much that's going to cost? Property like this, roughly the taxes are about $300 a month. The insurance is about $150. I know that because I've looked at a lot of these properties that are similar to this one. So that's why I'm confident in this. And that's why I put those numbers in. But of course, you would have to do your research and analyzing which market and what property and all that kind of stuff for yourself. The utilities are paid by the tenant. So that's why I haven't included them here in this number. Property management. This is another important line here that a lot of people skip over. In Canada, we've seen numbers as low as 6% of your gross rent and as high as 15% of your gross rent. So for the purpose of this analysis, I'm throwing in 10% here for property management. But if you're not sure, again, this is phone calls to property management companies, asking them what they would charge to manage a property similar to the one that you're looking to buy. What are your costs? How does this work out? Some may not even charge based on gross rent. They may have a flat fee. These are the things that you're going to need to figure out when you're analyzing a property. I'm using 10% here in this example so that we have a round number of, remember, 10% of the gross rent ends up being $350 a month. A couple other what we call soft costs we want to consider when it comes to analyzing a property are, what are my repairs and maintenance going to be like on this property? If it's one that is somewhat fully renovated already, or maybe it's a newer property, this number can tend to be lower. If this is an older property or there's some deferred maintenance, we want this number to be higher. And remember, this is a number we're putting aside every single month. It does actually accumulate in our bank account, but we're putting it aside every single month to make sure that, that $175 goes into the bank account. Assuming we're not spending it, it's building up in there and it's being added to this reserve fund that we originally put in the bank account when we go to buy this property. This property we're talking about here is nearly all renovated. We just have some lipstick and rouge touch-ups, we call it, some slight repairs we're going to do at the beginning, which we've accounted for down here in our repairs and maintenance. So we're expecting a lower percentage. So I put in a 5% repairs and maintenance here. And of course, I've done a little research based on CMHC or other, talking to the property management company as to what the vacancy rates in that particular neighborhood for that particular type of property are going to be. And I'm putting 5% vacancy in here. So as you can see, as we go through this process, guys, there's a lot of areas here we want to do our research on. We want to be talking to members of our team, our property managers, our realtors, maybe our contractors to get quotes on certain things. We want to do that ahead of time, our insurance agents, and get these numbers streamlined so we know what they're going to be and we're not surprised by some extra expenses. Because let's say now, if this goes up by $500 a month, well, now we're a negative cash flow on this property. So again, our income, figuring that out is going to be very important, but also our expenses, figuring that out accurately is going to be very important as well. So you'll notice in this particular case, we're expecting $3,500 a month in rent. We're expecting $3,200 and $3,285 in expenses. That gives us a monthly cash flow of roughly $215. Okay, there's our analysis. We've done the numbers. It's going to cost us about $116,000 to buy this property. We need to qualify for a mortgage that's at $400,000. And once we have our tenants in place, we're going to cash flow a couple $100 a month. Now we look at that and we say, okay, well, maybe some of you are looking at that and saying, okay, well, this is a good kind of property to buy. Or some of you are looking at that and saying, well, what's the point to buy a property that's $200 a month in cash flow? And both of those views could be valid. But there's other things involved in analyzing a property that we still need to look at here, guys. And that's this section down here, our estimations and questions. So one of the important questions on here is, what do we expect from market growth? What is our estimate per year? And so if we're comparing different properties in different markets, this number could be dramatically different. In Canada last year, we had some markets go down in value, but we also had some double-digit increases in value. So markets that went up 10% in value or more. So depending on where you're buying in the country, this number can dramatically change. The particular market we're looking at here, we are expecting roughly a 3% growth rate. Now, we are being very, very conservative on that number because the particular market we're looking at, and remember, the guys, this is an example, but the particular market we're looking at has gone up on average 5 to 7% for the last 10 years. And so to be on the safe side, we're only expecting 3. So that's why we put a number of 3 in there. And of course, there's a lot of other factors that come into trying to make these estimations. But remember, this isn't an analysis. This isn't a guarantee by any means on any of these numbers. The purpose of this property analysis is to help us determine if this is a good investment or not, but also help us to compare this investment with other properties as well. And once we have a few of these side by side, then we can start to determine which one is the better one to buy. A few other questions we want to make sure we know ahead of time is, who is going to manage this property? That could be you. That could be a property management company that you've been talking to already. But we want to know ahead of time who is going to manage this. As soon as we buy it, we're going to need to be putting tenants in there. We're going to need a property manager. The next question we're going to leave blank for now. Can I find a partner who will invest with me on this property? We'll come back to that in a second. How long do you plan to hold this property is a very important question. Now, that could be 3 months if you're planning to flip this property. It could be 25 years if you're planning to keep it long term. I would say on most cases, people that are planning to hold a property long term, you're a minimum of 5 to 7 years before you're going to see enough market growth, enough mortgage pay down, and enough cash flow to accumulate for it to be worth it. So in this particular case, I've written in here 5 to 7 years. That's kind of what our plan for this property would be. Another important question, what is my exit strategy with this particular property? Now, why is this question important? Well, we've seen a lot of investors buy properties, turn them into investment-only properties. So I'll give you an example. You might go and buy a property that is owned by a homeowner. And what we've done is we've taken all the bedrooms, we've added more bedrooms, and we've now renting as a student rental. Maybe we have a 10-bedroom student rental in this home that used to be a 5-bedroom single-family home. Now, that's all great. That increases our cash flow dramatically. But when we go to sell that property, we could be now just selling it to other investors. And they're going to be looking at the numbers instead of selling it to homeowners that may have an emotion attached to that purchase. And so we are starting to limit the amount of people we may be able to exit or sell that property to down the road. If we change the use of a property, we may start to limit the amount of people that will purchase it at the end. So we want to be clear on what our exit strategy on that particular property is going to be. In this case, I'm planning to keep it as a homeowner type property. I'm going to sell it to a homeowner and probably do some staging at the end. Get the emotions involved when people walk through. I'm going to make it look really good, fix it up, that kind of a thing. And I'm looking to sell or refinance at the end of 5 to 7 years. Next question, what would I grade this purchase out of 10? We're going to leave that one and come back to that one too. If you have to hold this property long-term, does it still work? Now, this is a very important question. If you're planning on doing a flip, maybe it's a 3-month, 6-month, or a 1-year type of acquisition, fix it up and sell it. But what if you can't sell it? Will you cash flow once it's fixed up? Maybe once you've refinanced, you have a higher mortgage payment to pay. Is it going to cash flow? If you have to hold this property long-term, will it still work? Is a very important question for you to answer ahead of time. And our last question here, we're going to come back to that as well. So the 3 questions we left blank here, we're going to come back to after we fill out our top 5 reasons why you would buy this property. And guys, this is a very, very important section of this analyzer form. And I'm going to tell you a few reasons why it's so important, because we need to know why we are interested in buying it. Is it the cash flow? Is it the low purchase price? Is it the fact that we can renovate it? Is it because it's close to where we live? Is it because it's in a market that's going up in value? What are some of the reasons why we're thinking of buying, or why we may buy this property, why it might be a good one to buy? So let's go back to this analyzer form here and let's look at some examples that I wrote in here beforehand. Example number 1, the neighborhood is under transition and the prices are climbing. So new homes are being built, old ones are being torn down. It's under transition. Maybe new restaurants are popping up. It's becoming a lively type neighborhood, which means high property appreciation. A good reason why we may consider a property like this. Reason number 2, there's a new freeway exit or entrance within a 5-minute drive of the property. That brings so many places closer to us. People can get to their jobs that much quicker. And it's maybe close to high paying jobs for our tenant. And I want you to notice something with every single one of these examples in this section, guys. I actually call this our which means section. Okay. Remember number 1 here, neighborhood is under transition, which means higher property appreciation. What does that mean for me as an investor? There's a new freeway. It's just going to attract tenants, which means it's close to a lot of high paying jobs. It's going to be easy for us to rent that out. Number 3, it's all fully renovated, which means the repairs and maintenance should be lower for us for years to come. It's across a street from a school, so it will attract family, which means we're going to be attracting our favorite tenant demographic. Point number 5, the property is bright and spacious, so it will be easy to rent out with minimal showings, which means less work for us and less vacancy. So I think you get the point here, guys, that we want to look for reasons why we would buy this property. Why, as an investor, is this a good property to be buying? What does it mean for you for the bottom line? Okay, why is this a good property to buy? And you need to know these answers, because a lot of times I ask somebody, why did you buy this property in the first place? Oh, well, it was a cousin's friend's brother that was selling it and it looked like a good deal, so I thought I'd buy it. Or, well, it was under market value, so I thought I'd buy it. Okay, well, if there's only 1 or 2 good reasons to buy a property, that may not be enough to buy that property. We want to have at least 5 reasons why it's good. And that brings us back down to this question at the bottom here. Can I find a partner who will invest with me on this property? Guys, for those of you that are wanting to scale your business, at the beginning of this video, I said here at Investor Life, what we do is we help investors scale their portfolio, scale their business by buying properties using other people's money or not using their own money. It doesn't matter who you are. You eventually run out of your own money when it comes to buying properties. So that's where partnering with others, bringing in investors to buy properties with you becomes a very good strategy to use. So that's where we would answer this question is, can I find a property who will invest with me can I find a partner who will invest with me on this property? Well, yeah, I think I will be able to, because one, it cash flows. Two, I have 5 solid reasons up here why I would buy this property. I think I'd be able to convince somebody to partner with me. So I would say, yes, I do think that I'm going to be able to do that. And so in this case, I'm going to fill that out and I'm going to put, yes, I can find a partner to invest with me on this property. I'm fairly confident. Why? Because I have good reasons as to why I'm going to be buying it. I'm in a market that's going up in value. We are cash flowing, even with a higher interest rate. These are all reasons why I think I could find a partner. So then what would I grade this purchase out of 10? I would say this is a solid 7, possibly an 8 out of 10 purchase. But this is where, when you set a few properties side by side, guys, remember, you're not just analyzing one property. You need to be analyzing more than one property so that you can set them side by side and have options as to which one is the best. You can grade them each. That'll help you pick which investment to buy. And then the last question, which is very important, all emotions aside, is this a good purchase? Remember, guys, as investors, we do not want our emotions to be making our decisions for us. We want the numbers and the facts and the reasons why we would buy this property, why it's good for an investor. We want all of that to stand out versus, well, I really like the layout of this property, or oh, it's so close to where I live, and so it's going to be easy for me to manage, or all these other reasons that our emotions can get involved in the property. Okay, so I hope that by going over this property analyzer form, guys, and once you've done filling it out, you can print it off, analyze another property, print it off, analyze another property, print it off. And when you've done a few of these, you set them side by side. That will then help you make a determination as to which property is a good one to purchase. That's, guys, how you analyze a property the right way. So I'm going to repeat myself one more time when it comes to this form, guys. Fill it out. Every single section of the form, fill it out. If you don't have a copy yet, the link for a copy of this you can download for absolutely free off of our website is in the description. So go there and download it and have fun analyzing properties. Have fun finding properties that will work for you as an investor and bring you closer to your goals. All right, we'll see you guys in the next video.